Well, Canada's status as an export-driven, commodity-sensitive economy means that Canadian assets and Canadian currency in particular are very sensitive to risk appetite and growth sentiment. And with our expectations for growth to be less robust in 2019, that means that Canadian dollar will have more of a headwind going forward. We have talked often about competitiveness challenges that Canadian economy faces, so recent weakness of the Canadian dollar hasn't been unexpected. But what we note in particular is that the adjustments, the framework that we operate with the adjustments in economic imbalances having to be resolved either through extreme currency weakness or through the length of the currency weakness, these adjustments haven't taken place yet. If we look at Canadian current account deficit, it has been in place since the great financial crisis. And if anything, if we look at foreign direct investments, there has been dominating Canadian outflow to invest in foreign economies rather than foreigners investing in the Canadian economy, which is surprising because it actually intensified in the past couple of years, despite the fact that US economy had strong growth and Canadian currency was cheap. What it tells us is that perhaps Canadian currency wasn't cheap enough to entice foreign investors to invest here. And that despite the fact that the US-Mexico-Canadian trade agreement had been signed, this is not improving Canadian competitiveness. This is simply not making Canadian competitiveness deteriorate further. The other factor that has been fairly positive recently was the change in the business tax rules for the businesses to entice them to invest. But again, this is perhaps more closing the gap, competitiveness gap of the Canadian businesses, but it is not tilting it in favor of the Canadian businesses. And finally, Canada has been losing market share of the US imports since 2002, and there hasn't been anything yet to address that. Our businesses invest much less in machinery and equipment and intellectual property than US businesses. There has to be a meaningful change in that landscape to help improve Canadian competitiveness. So despite these obvious challenges, at some points last year, surprisingly, Bank of Canada was striking quite hawkish note, and investors were at some points actually expecting the Bank of Canada to hike as much or more even than the Fed. Well, with the recent weakness in Western Canada select oil and oil prices in general, and the acknowledgement by the Bank of Canada that economic growth is under a bit of pressure here versus expectations. These expectations for hawkish Bank of Canada probably will be brought down to earth, which makes us believe that Canadian dollar may trade around 131 within the 130-140 range over the next 6 months, and we would be quite comfortable expecting Canadian dollar to remain on the weaker side of fair value.